The confidence gap, no chart shows. Nothing collapsed on the screen. Prices held their shape. Indicators stayed calm. Yet beneath the surface, a gap opened that no chart could capture. And that gap would quietly change everything. To understand why this matters now, we need to look beyond price and volume. Markets don't move on numbers alone. They move on confidence, on the shared belief that when uncertainty appears, someone will step in. That belief isn't plotted, it isn't measured, but it holds the system together. For a long time, confidence felt intact. Trades cleared smoothly. Pullbacks resolved quickly. Participants trusted not just the data, but each other's reactions to it. The market functioned because everyone assumed response would arrive on time. The first reveal begins with a subtle shift in behavior. Participants still acted, but with less urgency. Decisions that once felt instinctive now required confirmation. Buyers waited for proof. Sellers tested a little longer. Nothing dramatic happened, but something slowed. The second reveal emerged through repetition. Each small disturbance took slightly longer to resolve. Recoveries felt procedural instead of confident. The market wasn't absorbing uncertainty. It was tolerating it. Confidence didn't vanish. It thinned quietly, session by session. The third reveal came when experienced participants noticed a disconnect. Chart said stability. Behavior said hesitation. Liquidity was present, but it felt conditional. Support existed, but it arrived late. The system still worked, but it no longer felt eager to work. That was the confidence gap. Not fear, not panic, but the absence of shared conviction. And that gap matters because markets rely on invisible agreements. Agreements about timing, about responsibility, about who acts first when something goes wrong. When those agreements weaken, price can remain calm while risk quietly accumulates. The market hadn't broken. It had drifted into a state where confidence was assumed, but no longer supplied. And once confidence becomes invisible, it becomes fragile. What followed would reveal how dangerous that gap can be, and why the most important risks often exist where no indicator is looking. As the confidence gap widened, the market continued operating as if nothing had changed. Sessions opened and closed calmly. Headlines stayed reassuring. To anyone focused on charts alone, the system looked stable. But confidence doesn't disappear all at once. It withdraws in small, rational steps. The conflict emerged in how participants handled uncertainty. When new information arrived, responses varied. Some acted quickly, others waited. A few stepped aside entirely. The market no longer moved as a coordinated whole. Reaction became fragmented, and fragmentation breeds hesitation. Liquidity reflected the shift immediately. Depth was visible, but it behaved differently. Bids appeared briefly, then faded. Offers refreshed cautiously. Capital was still present, but it no longer felt obligated to absorb imbalance. Confidence in response was weakening. The tension deepened as this behavior repeated. Each delayed reaction reinforced the next. What once felt like noise began to feel directional. Small moves traveled further than expected, not because pressure increased, but because resistance softened. Institutional desks noticed a change through execution metrics. Trades took longer to complete. Slippage crept higher. Timing became unpredictable. Strategies that relied on fast resolution struggled quietly. The market still functioned, but its reflexes had slowed. Derivatives markets captured the discomfort subtly. Protection stayed bid even during calm periods. Skew refused to normalize. Traders weren't hedging fear, they were hedging hesitation. The risk wasn't collapse. It was delayed response. The buildup continued as confidence leaked further. Participants adjusted without naming the cause. Position sizes shrank. Time horizons shortened. Optionality replaced commitment. These changes weren't defensive, they were adaptive. But adaptation, when shared broadly, reshapes the market's internal balance. Veteran participants recognize the warning signs clearly. Markets don't need bad news to weaken. They need uncertainty about who will act. When confidence fades, liquidity loses initiative. And when initiative is lost, small imbalances travel farther than they should. The market was still standing, but it was standing over a widening gap. The next phase would show what happens when that gap finally matters, when the market is forced to rely on confidence that is no longer there, and why the adjustment feels sudden, even though the weakness has been building quietly all along. That moment arrived when the market faced uncertainty that required coordination instead of patience. Not a shock, not a surprise, just a situation where confidence needed to show itself through action. It didn't. Prices moved, then stalled. Buyers hesitated. Sellers pressed a little further. The familiar rhythm, pressure, response, recovery, failed to complete. The confidence gap that had been invisible now shaped behavior in real time. The conflict intensified as hesitation fed on itself. When buyers delayed, sellers gained room. When sellers pressed, buyers waited longer. Each step felt rational on its own. Together, they widened the gap. The market wasn't afraid. It was unsure who would act. Liquidity revealed the truth clearly. Depth appeared late. Support formed only after levels were breached. Capital responded to confirmation instead of creating it. Confidence no longer led the market. It followed it. Institutional systems reacted mechanically. Algorithms reduced aggressiveness when signals conflicted. Risk controls trimmed exposure incrementally. Committees revisited scenarios. Every adjustment made sense individually. Together, they removed even more initiative from the system. The buildup accelerated as correlations tightened. Assets that normally balance one another began moving together. Diversification weakened quietly. Strategies designed to smooth transitions now amplified hesitation. The market grew heavier with each unresolved move. Veteran participants recognized the danger immediately. Confidence isn't about optimism. It's about coordination. When coordination breaks down, markets don't need fear to destabilize. They need uncertainty about leadership. As pressure persisted, familiar support levels failed without drama. Not because sellers overwhelmed them, but because buyers never arrived with conviction. The market adjusted lower in stages, each one confirming how much confidence had already drained away. That was the realization. The confidence gap wasn't theoretical anymore. It was structural. And once confidence becomes structural risk, recovery no longer depends on price alone. It depends on rebuilding belief. The final phase will reveal what happens after market is forced to confront that gap, and whether confidence can return once participants have learned to operate without it. Because gaps that don't appear on charts still demand to be closed. When the adjustment finally unfolded, it felt heavier than it should have. Not violent, not chaotic, just persistent enough to expose what had been missing all along. The market wasn't reacting to bad news. It was reacting to the absence of confidence. That was the climax. The confidence gap that no chart could show had become the dominant force shaping outcomes. Support failed not because selling overwhelmed it, but because belief never arrived to defend it. Liquidity returned only after direction was clear. Capital that once acted instinctively now waited for proof that action was safe. What surprised many participants was how orderly it looked. No panic, no disorder, just a steady repricing in a system where coordination had already broken down. The market was doing exactly what it had been trained to do, react instead of lead. As volatility settled, the resolution emerged quietly. Participants adapted. Strategies were simplified. Position sizes shrank. Time horizons shortened. Confidence was no longer assumed. It had to be rebuilt deliberately. The market stabilized again, but on different terms. Those terms mattered. The new equilibrium was less forgiving, more sensitive to early moves, more dependent on clarity. Confidence didn't disappear permanently, but it stopped being automatic. It became conditional, earned through consistency rather than inherited through habit. The deeper lesson lingered beneath every decision that followed. Markets don't fail when indicators turn red. They fail when invisible agreements dissolve. Agreements about who steps in, who absorbs uncertainty, who acts first when something feels wrong. The confidence gap wasn't created by fear. It was created by hesitation. And hesitation, when shared broadly, reshapes markets faster than panic ever could. Understanding this changes how stability should be read, not as proof of strength, but as a question. Is confidence present or merely assumed? Are participants coordinating or just coexisting? Because when confidence exists only on charts and not in behavior, the market is already more fragile than it looks. So, what do you think? Are we mistaking calm indicators for real confidence right now?